Hi, everyone. Happy Monday. I wanted to post because I've gotten a number of questions regarding what experts mean when they say there's a potential for cracks in the bond market. So, Jamie Dimon, who is the CEO of JP Morgan at a conference, recently said in response to the big, beautiful bill and the debt that comes with that, that this is a huge risk and will lead to cracks in the bond market. Ben Harris of the Brookings Institute has also said that there will be a day or a decade of reckoning in the bond market as well. So, to explain this, I'd first start with the way that the bond market works. As demand for bonds drops, the price for those bonds also drops because there's less interest in them. And as the price for the bonds drops, the yield or expected return goes up because those investors are now looking for a higher return. So, the crack in the bond market would occur if there was a massive exodus of capital from the US. And there are fears that this could happen if the US is seen as a less safe and less desirable investment for global investors. So, if there were massive quantities of US treasuries being suddenly dumped in the market, it could lead to that crack in the market that they've been referring to, because a sharp drop in bond prices leads to an evaporation of liquidity. This is because cash must be returned to the seller of the treasuries, and that cash must come from within the banking system. And with the sharp decline to a level that triggers margin calls, that would require cash back in from hedge funds that had taken loans out against their holdings. And on a huge scale, it could overwhelm a bank's ability to supply the liquidity required. And there are a couple red flags that these cracks might be emerging sooner than later. The first is that long term yields for bonds have not been behaving as they traditionally do. For instance, when the stock market falls, you typically see the bond yields fall because the capital is moved to what is typically deemed a less risky asset. But in recent months, we've actually seen the opposite occur, suggesting that capital seeking safety did not move into US Treasuries but moved elsewhere. The other red flag is that the Fed and now the US Treasury both seem to be taking action to try to offset the increase in bond yields. I'll make a separate post about this, but effectively, they are buying back US Treasuries, which injects liquidity into the banking system. At the same time, it helps bring up bond prices and lower the yield to offset the increase in long term yields that has been occurring. My 2 cents is aligned to the experts. It could happen in a day or it could happen in a decade, but when it happens, it will create financial turmoil across the globe and the stock market will drop with it. And for this reason, I always recommend ensuring that your risk exposure is aligned to your risk tolerance and that you have a very well diversified portfolio and you are not exposed to any one risk. I hope that helps.